A very warm welcome and thank you for being here today and watching this live broadcast. I'm Anindya Banerjee from Kotak Securities. I'm the one whom you should be calling whenever you need a view on the rupee. Over the past 8 years or so, I have been advising our retail clients on how to make money in this market. And it's not just that, even our esteemed corporate clients call me whenever they need to manage the risk which they face on their exports and imports. Because currency is a highly volatile market. Now you might be thinking, how do I do that? I'll tell you the secret. It's a very simple process, but it's definitely not easy. Past 15 years, I've had the great fortune of tracking very closely some of the largest asset classes in India: the equity, currency, commodity, and bonds. Now that multi-asset experience provides me with valuable insights, which helps me to navigate this wild and interesting market of currencies. Over the next 1 hour or so, I'll be taking you through an interesting journey where I'll be discussing the nuances of this market, as well as I'll be telling you how you can benefit from the currency derivatives. So without any delay, let me begin. Now the talk will be having four sections. In the first one, I'll be addressing four important questions. So which are the how, the why, the where, and what of currency trading. After that, I'll be taking up the factors and drivers of currency value. And we'll be taking the example of dollar rupee because that's something which is uh, very close to our heart, and at the same time, something which is worrying us a lot at the current moment because of the rupee depreciation. And no talk is complete without a view. And finally, the cherry on the topping is going to be a discussion on the mistakes and myths which people make in this market. So, why currency derivatives? A very important question. Why are you here to listen to me? The first point is leverage. Now, what do I mean by a leverage? Let's take the example of Nifty futures. If you trade Nifty futures, you have to pay a margin of around 7%. And what is the daily volatility in Nifty? 0.5% to 1%. In currencies, not just dollar rupee, there are other six pairs of currencies there on the NSE. The daily fluctuation is also between 0.5% to 1% currently. And how much of margin you pay? If I take the example of dollar rupee, around 3%. So compared to Nifty, where you pay 7% margin to enjoy the same kind of volatility in percentage terms, in the dollar rupee you pay half of that as margin. So it makes sense that with the same margin you can take a bigger exposure in this market. And there is another interesting point that unlike equity derivatives, there are no bulls or bear trends. What I mean is that in currencies, there are only trends. Either it's a sideways trend, or it's an uptrend, or it's a downtrend. And unlike equity derivatives, where individuals find it difficult to short, like what is happening now as the market is collapsing, they like to be, say, long only. So they buy first and then they sell. In currencies, there are no such psychological issues. People go short, they go long all the time. And unlike equity derivatives, in currencies, you can trade from 9 to 5 on the rupee. And on international currency, you can trade all the way up to 7:30 p.m. And there is a talk going on that this time can be extended further. So just imagine a situation. We are at times when a tweet from Donald Trump can completely sway the markets. Let's say a tweet arrives on China and the trade war around 4 p.m. after the equity markets are shut, and it creates a mayhem. There's a big sell-off that happens after the tweet. He attacks China. Just is a hypothetical scenario that I am constructing here. Now, you can't do anything because the equity market is shut, but you can definitely take a position in the currency market. And if the view turns out to be right, you can make money on that position. And on the same time, you can also hedge your equity portfolio, at least the overnight risk from that news. So that is the advantage of an extended trading hours in currencies. And also, there are individuals and corporates who have to make dollar payments or payments in other currencies, and they face a risk. Like right now, a lot of people have to make dollar payments, and because of the weakening rupee, how do you hedge yourself? How do you protect yourself? So, currency derivatives offers you that avenue. Now, once we've addressed the how, we come to the next important question: what to trade in the FX? So we have two exchanges, NSE and BSE, on which you trade equity derivatives currently. So there are 7 instruments available on which you have the futures and options. And this is a list of what are the contract sizes. So roughly, one can say that on the rupee pair, so if I take the rupee pairs like dollar rupee, the contract size is of around $1,000, and the tick size, that means every fluctuation, is of quarter of a paisa, and the tick value means if one tick moves on one contract, the fluctuation in your P&L would be around 2.5 rupees. The same goes for the euro rupee, on the pound rupee, as well as on the yen rupee. Now there are 3 international currencies like the euro dollar, pound dollar, and dollar yen. They also have a similar 1,000 unit contract size, and the calculation on that is a little different, but it roughly boils down to around 6.5 rupees is the impact for every one tick move. So the 7 currencies are all quite volatile, and at the same time they are very liquid. And as I covered in the beginning, the market timings are 9 to 5 for the rupee pairs, and for the euro dollar, pound dollar, and dollar yen, which are international currencies, it is up to 7:30 p.m. Monday till Friday. Now, something interesting here is that if you see in each of the instruments, it's a pair. This is something unique about the currency market. When you trade equities, let's say you buy Reliance or you buy Kotak Mahindra Bank, you are basically buying in something absolute, because what you pay is in rupees. Let's say Kotak Mahindra Bank is at 1400, so it is 1400 rupees. The same thing for a bond, same thing for a commodity. But currency, whenever you buy and sell something, it is always in relation to another currency. This is something unique about the currency market, that it is quoted as a ratio. So USD INR basically means, let's say the current price is at 72. What it means is that 72 rupees per dollar. So let's say euro rupee or euro INR, it's at 85. It means 85 rupees per euro. So it's always we are trading a ratio, unlike the equity bond or the commodities market. So that's something very unique about this market. That's the reason why I said at the beginning that there are no bull trends or bear trends, because it's always a ratio which you are trading. They're only trends. So now the next important question comes is how to trade the FX market or the currency market. So there are a number of strategies which are employed, or kinds of trading which we see individual traders and even institutional traders undertake. Like for example, somebody who is doing an intraday trading, because the currency market provides so much of volatility on a daily basis, that there are a lot of traders, individuals as well as institutions, who don't like to carry positions from one day to the next. So they are going in and out throughout the day in all the 7 pairs. Or somebody could be just focusing on one pair, let's say dollar rupee. So if I'll be focusing on dollar rupee and going in and out, so buying and selling or buying throughout the day as the opportunity presents. So no positions are carried forward throughout the day. So and the turnover or the frequency of trading is very high. Then we have something known as swing trading. Swing trading means you basically take positions and they are taken for overnight, and it may run into a couple of days. So you're trying to capture a swing. Let's say, I'll take a live example. It happened last week. Dollar rupee had gone all the way to 73 against the dollar, and it corrected down to 71 half. Now, somebody who was waiting for a correction to buy again dollar, so would go long around, let's say 71.8 and put a stop loss around 71 half to play for another 1 rupee over the next couple of days. So that is a swing trading. You are trying to catch a move that lasts for a day, uh, 2 or 3, not more than that. So obviously the frequency of trading is just less than intraday trader. A positional trading, on the other hand, would last for a couple of weeks to even months. Now, this kind of trading in currency market is relatively less compared to the first two, intraday and swing trading, because currency market is a place where traders enjoy volatility. It's not an investment product; it's a trading product. So that's the reason why positional trading is done, but it's done not so frequently. But there is a kind of trading which I'll be talking about. It's called carry trade, which one can classify under the positional trading, and which is very popular, not just in India. It's popular with all currency traders all over the world. It's called carry trade. Now, what happens in a carry trade is that because dollar rupee is trading at a premium from 1 month to the next. So let's say dollar rupee for spot delivery, that is delivery uh, from 2 days from now, is at 73, the price which you see on CNBC. Then 1 month from now, that is futures which will expire 1 month from now, will be at a premium. So let's say at 73 quarter. 2 months from now, it will be at a premium of 50 paisa over the spot. So 73 half. Now, why is this premium there? This premium is there because of the higher interest rates which India has over America. So this is basically the interest rate differential. It is not any forecast on the future prices. So what traders do, positional traders, they do what, they go and short the dollar, and they keep rolling it every month. So this is called Beyaj Badla, which a lot of people have done in the past, and they still do in equity or even in commodity. So this trade works when the rupee is at worst stable against the dollar. So if, let's say, rupee stays at 73 for the next 3 months. So 3 months, the third month future right now is at 73.75, and the spot is at 73. So 75 paisa premium. So after 3 months, if the rupee stays at 73, the 3 month futures will expire at the spot, which will be at 73. So the trader who went short on the third month futures and kept it for 3 months will make 75 paisa. So that is the typical concept behind a carry trade, and it works amazingly well, as I said, when if the rupee is stable at worst, and if it is appreciating like it was in 2017, it makes phenomenal amount of money. But it is a dangerous strategy in an environment in which we are in, where rupee is already down 14% from the February highs, because here you will lose much more than what you will make just from the Beyaj, from the Badla. And the fourth strategy is option strategies, because option market in dollar rupee is very liquid, and you can employ the same strategies which you employ in equity derivatives. There are a number of strategies like buying a vanilla call or a vanilla put, or even doing call spread, put spread, and things like that. So that is can be easily done, and liquidity is not an issue, and it is a way in which the retail and individual clients participate in a volatile environment, like right now in dollar rupee, where the movement has become quite high now, where the currency is moving almost like 80-90 paisa every day. In such environments, people don't want to take unlimited risk with a futures trade. So they like to use options, and even option strategies like call spread or put spread to execute the view. So those kind of strategies become quite lucrative on a risk to reward basis. And we have a dedicated research desk, and we specialize in generating calls. So we are constantly giving intraday calls, positional calls, and also the hedging advices go to the corporate clients, which will be available on your Kotak stock trader, which is a mobile trading app which comes as a notification. you will be you may have seen the calls or the notifications on dollar rupee which come early in the morning at 9, a little before 9, and on also during the day, and also comes just before the markets close at 5. And there it is also available with your dealers if you're an offline client, and the dealer will be communicating it to you. You can also get in touch with your RM as well. If you are having a desktop platform, it will be coming there as well as research advice on currencies. Now, this is just an outlook of where you can trade currencies with Kotak Securities. These are all desktop platforms. Like you have the Fast Lane, which is there once you log into your account, which is a Java-based platform. And then you also have the Keat Pro, which you can download, which is quite a very interesting platform. So there you can see, if you follow my cursor on the right hand side, you will be able to see the spot. Now this is important because on dollar rupee, as I said, spot is important because this is the rate which you see everywhere. When you go to Google and type dollar rupee, when you look at CNBC or ET Now or Bloomberg, this is the rate which you see if you just uh, follow the cursor here on the right hand side. And these are the futures rates. So you have the USD INR, again, just keep following my cursor, for September contract, and then the GBP INR, the Euro INR. So these are the rates. Like this screenshot was taken yesterday. So when dollar rupee for September was around 72.59, and the spot was at 72.53. Expiry is 26th September. So this is a trading screen which you can do. You can also trade the same currencies on your mobile app as well. It is easily available on the dashboard, both the spot as well as the futures. So you can also call up the customer care if you need help on that. So once we have addressed these four questions, let me move to the next part, which is the factors which drive the currency. In this case, we are taking the case study of dollar rupee because that's something which is close to us. So what really drives the value of the dollar rupee? So when dollar rupee is going up, so it's going from 71 to 72 to 73, just means that you are getting more rupees for every dollar, which basically means that the rupee is depreciating. If it is going from 74, 73, 70, and 69, it means we are getting less rupees for every dollar, which means the rupee is appreciating. So that is the convention. Now, three types of factors which affect the USD/INR value. One is the economy. As Bill Clinton famously said, it's the economy stupid that won him the election, right? So it is important for the currency. Then you have the markets which impact, like the Indian markets and the world markets. Now, what to watch in the economy? The most important thing is growth. What is happening to India's growth, which can be understood from the GDP growth rate, as well as vis-a-vis the Americas? That has a huge bearing because if an economy is growing faster, it will attract capital into the country. And when capital comes in, or foreign investors invest, or NRIs invest, the currency becomes strong. So this is a very important indicator which you should keep an eye on. The next point, which is very important, is inflation and interest rates. What is inflation? See, the biggest enemy of a currency is inflation. That's why the RBI, you keep hearing, is talks about we need to keep inflation down. The government is trying to keep the inflation down. And quite successfully, the Modi government, unlike the previous government, has been able to keep the inflation down for a long period of time. This kind of a low inflation environment India has not achieved in a long, long period of time. At the same time, they have kept the interest rate higher than the inflation. Why is this important? It's simply important because just imagine if inflation is at 8% and you go to a bank and get only 4%, it means that by keeping the money in the bank, you are becoming quite poor because the cost of living is 6% or 8%, and you are getting 4% on the money. So that has been the case for India for a very long time. That's the reason why people were not very eager to put money in the banks. They started to put money in real estate and gold, and that always was negative for the economy. especially when you're investing in gold, and also became a negative factor for the rupee as well. But things have changed since the new government has come in and Dr. Rajan became the RBI chief in 2013. Interest rates have consistently stayed above inflation, and that has ensured a couple of things. Money has moved back from gold and real estate into financial assets like banks. It's into the equity markets and bonds. And at the same time, it has strengthened the rupee as well because attracted a lot of capital flow from abroad. I'm talking about strengthen the rupee, we have to ignore the last few months of depreciation because those are factors which I'll come to when I take up the view. So interest rates and inflation is a very important thing. So every month the CPI inflation comes out. We have the CPI as well as the WPI, which is the consumer inflation and the wholesale inflation. Focus on the consumer inflation. If that inflation is staying low, and RBI is maintaining a higher interest rates, it is positive for the currency. At the same time, you have to also watch, because as I said, it's a pair. You have to also see the inflation of America and also the interest rates in America. If interest rates in America is rising and inflation is lower, it will also be negative for the rupee because it should be on a relative basis. So interest rates and inflation has to be seen for India and America as well. That's the reason why there is a lot of talk you hear that because Federal Reserve, that is the Central Bank of America, raising rates, it is taking the dollar higher, which is true because in inflation in America is still low compared to India. And because interest rates have started to rise and it's a developed nation, it starts to attract capital back from emerging markets like India into developed markets like America. That's the reason why dollar is strengthening. So this is a very important indicator. And then is the political scenario. It's very important. So growth, inflation interests, and the political scenario. Because let's see 2013 or 2012 when there was political instability, and then 2014 happened. So when there is a political instability, foreign investors and even domestic investors are not eager to invest, be it in factories or roads, or be it in the stock market or bond market. So that is not only negative for the economy, that is also negative for the currency. So we have a big political risk coming up next year, 2019, the national elections. So we hope that the political stability continues, and that will be a major positive factor for Indian financial market as well as the currency. And now we're from the macro factors, means economic factors, we will move to the market factors because currency is like, it's like a lung or a heart in a human body. It's constantly getting impacted by everything in the human body. So you have to look at all the nuts and bolts from economy to global markets to domestic markets to understand what will be the larger direction of the currency, in this case the rupee. So the important factor to watch here is going to be the flows. But it is simple. If the foreign investors are going to invest more money into India, then the rupee is going to be appreciating, or it's going to strengthen against the dollar. So what has happened here of late? What we see is that since the beginning, or since around Feb of this year, the FIs have been largely selling. The foreign portfolio investors are exiting India, and this is not just exiting in India. They are selling in emerging market as a whole because of various factors. One is the rising oil prices. Two, the trade war between China and America, which is slowing down the Chinese economy. That is the largest emerging market economy, and that has a risk of slowing down the world economy. Due to also the rising interest rates in America, which is pulling money. It's kind of because when interest rates go up in a developed market like America, it's like a magnet. It starts to pull the capital from all over the world. It's like magnet and iron filings. The magnet is getting stronger. It pulls all the iron towards it. So these are the reasons why there is a massive outflow which is happening from emerging market nations like India, Turkey, Argentina, Russia, Brazil, South Africa, Philippines, Indonesia, Malaysia. So these are all countries which are seeing. So that's what we are seeing on the graph. But interestingly, what you also see is that now, before I come to the interesting relation, so because of the FI interlinkage with or the flows, there is a strong inverse relation between the dollar rupee and the Nifty. So when Nifty is rising because of the inflows from FIs, the dollar rupee is falling, which means rupee is appreciating. But when the Nifty is falling because of outflows, rupee is depreciating. That is intuitive. But right now, we are seeing something interesting because right now, if you see on the right hand corner of the chart, just this bit, for this year, a larger part of this year, if you leave out the last 1 week of sell off in the Nifty, Nifty is rising, Nifty was rising, and rupee was depreciating. Now, why this happened? Why rupee was say depreciating? That's clear because I talked about the outflows. But the reason Nifty was still rising in spite of the outflows is because the the domestic money, the money which is coming from the domestic investors, is still pretty large and is so humongous that it is able to offset the outflow from the FIs. So that's the reason why, because of domestic money, the Indian equity is rising, and because of foreign outflows, the rupee is falling. Now, how long can this persist? We have seen that this trend has snapped this past week, and Nifty has fallen, and also just not the Nifty, the entire market has corrected. So probably this trend is reversing. This is not a norm. This is an exception because it just cannot be that outflows keep happening from the equity market from FIs and only the DIs keep buying. So so keep an eye on the FI flows, keep an eye on the rupee before you go out and invest in the stock market. Now, as I said, it's not just the domestic market, global markets are very important. And you cannot ignore that. This is where a lot of people make the mistake. They have a home bias, means they only focus on everything domestic economy, domestic financial markets. They ignore the global economy, they ignore the global markets. Because always remember, when you are looking at the currency, it's always a pair. So pair has two sides, global and domestic. You cannot ignore that. There are times when domestic factors are driving dollar rupee, and there are times when global factors are driving dollar rupee, and there are times when both are driving it. So if I take an example, 2017 last year, domestic factors mainly and partly global factors was behind the big 15% appreciation in the rupee in 1 year, if I take into consideration the interest rate. And this year, primarily it is global. So I would say, if I have to put a subjective number, I would say 75% of the depreciation in the rupee is because of global, and rest 25% is due to domestic factors. So in the global factors, the first thing which comes to mind is oil, because India imports almost all of its energy needs, a bulk of its petroleum needs. So uh, it is a substantial number. So around $9 to $10 billion of imports we do on oil every month. So as the oil prices have started to rise, which we see on the graph, the yellow line, it started to pull the dollar rupee higher. So oil is something we need to watch. Then the next point is dollar index. Now, what does dollar index mean? This means that how is dollar doing? Like, there is a Nifty index, which is a basket of equity stocks into one index. So similarly, it is a basket of other currencies against the dollar, like the euro, pound, and etc. So it gives you a flavor of how dollar is doing against other international currencies. So when dollar index is rising, it means dollar is strengthening against the major currencies around the world, and that has also a negative impact on the rupee as well. So there is a positive correlation between a dollar index and the dollar rupee. But off late, we have seen that dollar rupee, or the rupee, has depreciated much more than what is warranted under or warranted by the movement in the dollar index because of other factors like oil. Oil is one thing which is contributing to that kind of depreciation. The third factor to watch is Chinese currency. Very important because it is one of the largest economy in the world. In fact, the second largest economy in the world, if after America. It's a 12 trillion economy. American economy is around 19 trillion, and it's the largest emerging market economy. So, and it has huge linkage in trade in emerging market and in the world. So, when China sneezes, emerging market does catch a cold. So the old adage, which was applicable for America, is now also applicable for China as well. So when Chinese currency, due to outflow from its economy, due to trade war, slowing down in growth, is happening, it is also affecting our own Indian rupee as well. Just see the graph. The white line is the dollar rupee, and the yellow line is dollar yuan. So both are going up, which means yuan and rupee both are depreciating together. This is, in fact, the correlation between yuan and rupee is much tighter than between the dollar index and the dollar rupee. So, which means you should be watching yuan rupee, yuan, the movement of the yuan, and the oil very closely to understand the future direction of the rupee. The fourth interesting chart is gold. So something very interesting that because gold is actually a currency, it's not a commodity. Historically, if you look at the human history, gold has always been a currency. In fact, it is only a currency in the world which is not owned by any central bank. So gold, when gold depreciates, it generally means that a dollar itself is appreciating internationally. So when there is a rush of funds away from the gold towards the dollar, then we see gold appreciation. So that generally goes hand in hand with an appreciation of the dollar against all the currencies, including the rupee. That's the reason why gold and rupee both have a positive correlation. During this time, gold was also falling and the rupee was also falling as well, because the blue line is the rupee dollar chart, not the dollar rupee chart which we have seen. It is the number of dollars per rupee. So a falling line means rupee is depreciating, and that's what we have seen. Of late, there is a kind of a disconnect which has come in. We have to watch this, because if the gold stock is not falling anymore, it could be a sign that the dollar strength is now ending, so which could be a positive sign for the rupee. Again, that's something which needs a more detailed analysis, but a very interesting development which is happening here at the right end of the chart. And this is another interesting chart which we have from the global basket. Now the white line is the dollar rupee, as which we can see. The yellow line is a ratio between the S&P, which is the US equity index, and the Indian equity index, which is the Nifty. And which, for what we have done is, because the S&P is quoted in dollar terms, we have also converted the Nifty into dollar terms as well. So what we are seeing is that when the rupee tends to depreciate against the dollar, when the US equity market is outperforming the Indian equity markets in dollar terms, which in simple English it means, as I said when I was discussing flows, is that the flows when American economy or American interest rates are become so attractive compared to the Indian interest rates on Indian economy or emerging market economy or emerging market interest rates, it starts to attract capital away from emerging markets towards America. When that happens, then we see the dollar strengthen. And this is the chart, the yellow line basically capturing that money is flowing out of equity markets in India and going towards equity markets in America. So keep a watch on that as well. Now the view, that's an interesting bit. Now what is the view? So if I encapsulate all the factors which we discussed, for domestic factors, politics, growth, interest, and inflation. Now, politics, we have a risk next year. That's a huge risk. Whether we'll have a stable government or we will have a hung parliament, we don't know. So that is adding to the uncertainty. Growth. The economy is doing absolutely fine. It's picking up speed after the two disruptions that happened, say, between 2016 and 2017. One was the demonetization. The other one was GST. Both of which had short-term cost but had long-term benefits, and we are seeing those benefits accrue to the economy, and economy is bouncing back. So the economy is a positive factor for the rupee, but also US economy is doing also quite well. So both are doing equally well. So when we see the impact on dollar rupee, probably it is neutral because both are doing well. Now, what about the interest rates and inflation? Again, interest rates are rising in America, interest rates are rising in India. Inflation is low in America, inflation is low in India. But oil prices rising may push up inflation more in India than America because we are a far bigger importer of oil than America. So, in terms of our total oil demand, so that means that inflation could start to rise faster in India. So again, if you look at the interest and inflation factor, it at best neutral. It could become negative for the rupee in the coming days. And then we come to the political scenario, which I already outlined. We have an uncertainty, but America has no such things at this point in time because their presidential elections are still 2 years away. So this part we can say that the three factors are either neutral or may be turning a bit negative for the rupee. Now on the domestic markets, the stock market is falling, which is negative for the rupee, and and we are also seeing outflows. So that is something not good for the rupee. So, and the third factor is the global markets. And global markets, Chinese currency is depreciating, dollar is rising against other currencies, oil is still high, and gold has stopped falling. So that is one positive. But it is like uh, three factors which are negative, one factor which is positive. So net net, it is negative for the rupee. So that's the reason why we continue to be bearish on the rupee. And though we may see some, say, near-term strengthening due to measures announced by the government of India or RBI or intervention from the RBI, the RBI is constantly selling dollars. But the larger trend of the dollar rupee is still upward until and unless we see the global factors change. So the Chinese yuan starts appreciating, oil starts to fall, and money starts to return from US to emerging markets. I think the larger trend of the rupee is not going to change. And technically, the traders who love to see charts, we see a clear breakout from a 5 year congestion. That is very important. That's the reason why we are seeing this kind of momentum. So 72 half is a key level to watch, between 72 to 72 half. The longer the dollar rupee stays above this line, 72 to 72 half, there is a big risk that we can see a blowout towards the next line, which is closer to 75 half to 76. So watch this line. Now this entire bullish view will be negated or completely altered if it starts to trade below this black horizontal line, which was the previous three all-time highs, which was almost at this same zone, so which is around 69. So as long as the market is trading above 69, the risk of a move eventually towards 75 to even 76 exists. Now, the last bit of the talk, which is going to be myths and mystics, and this is a very important part. Now, there's a one big myth in the market which I've seen over the past 8 years or so, is that people think that there is a link between gold, means as if the rupee has a backing of gold. So RBI can print only so much of rupees as much as gold it has, and that way any other central bank. That's not the case. In 1970s, the link between gold and currencies was uh, severed, and as a result of which, right now almost all of the currencies are paper currencies, which means they have no link with gold of any kind. They are simply traded on the faith of the government and the policies which they do, the central banks. So this is one myth. And the next thing is that RBI controls the rupee, and this is what we keep hearing from the market participants now. What is the RBI doing? Why can't it control depreciation? Why can't the government control? It is not possible because of the factors which we just outlined. That it is much more global in nature. In fact, uh, if you look at the total trading volume in dollar rupee, we have two kinds of markets. One is the onshore market, which is the market which is within the borders of India, and the other one is the international market, or we call this as a NDF market. If we compare the volumes of the international market in dollar rupee and the domestic market in dollar rupee, it is almost equal in size, and that so it just shows how big the international market in dollar rupee has become, and it has a huge impact on the prices in the domestic market. So keep that in mind. The next point is that China wants to unseat the US dollar as a reserve currency. No, it is not, because if China wants to do that, it will adversely impact the Chinese economy. And as long as China continues to be a net exporter, it cannot afford to have its own global currency. So that's a myth. And then again, the fourth factor, very, very important. A lot of even seasoned economists get this wrong, is that they look at trade when they're trying to judge the value of the rupee. You keep hearing about current account and current account deficit. This is a big myth. The scope of this presentation doesn't allow me to get into the details of that, but this is a very important factor that uh, just focus on capital flows. Don't focus on trade, on exports and imports, on current account. Just focus on flows and the factors: FPI flows, FDI flows, NRI flows, and what are the factors which will affect those flows. If you can focus on that, you'll be able to get the direction of the rupee right. Focusing on trade will not give you any clarity. And then the whole point that weak rupee is good for India, some economists will say, others will say no, it is bad for India. It depends on the context. For example, if I'm talking about an exporter, depreciating rupee like right now, it is good. But for a consumer, for an individual consumer, it is bad, because a large part of what he or she consumes, it has an import component in it. For example, crude oil has an impact on everything because it is a main fuel for transportation. So higher or weaker the rupee, it starts to impact the budget of individual consumers, and that starts to affect consumption. So it depends on which part of the economy you are looking at. That's how you can frame whether the weak rupee or the strong rupee is good or bad. Now, from myths to mistakes. The first mistake, which we have seen n number of times with individual clients, is that not taking stops, not having stop losses. This is a dangerous crime because this is not equity. You cannot have just be buying something and forgetting it for a long term. This is a derivatives market where you got to have stops, because trends are continuously happening. As I said, trends can be sideways, up or down. So if you are not taking a stop, you will get stuck in a position, and then you won't be able to take benefit of the next trend, and also you will be losing much more money than what you intended to risk. So as a rule of thumb, it is said that in money management, that whatever capital you have to risk, let's say you have 10 lakh rupees to risk, you should not risk more than 2% of that capital in one trade. So that means 20,000 rupees should be your max loss in one trade. So accordingly, you have to decide your stop and the amount of position or the number of contracts that you can take. So money management is most important. The best of the traders go bust because they don't have proper money management, and average traders make money because they have sound money management. So this is something which most people ignore, but at a very huge cost. So please do not uh, 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 continue with this mistake of not having stop losses. Then I talked about the carry trade, where I explained you sell and roll. It's like a Bajaj Badla. So it works in a market where rupee is not depreciating like it is now. If you try to do that kind of a strategy here, it can be quite painful, and it can incur quite huge losses. And then averaging. Please don't average. This is not equity. This is not buying a stock like Nestle at 10,000 and thinking that it's a great business and trying to average it down to 5,000 because of a Maggie fiasco. No, no, no. It's not that. This is a derivatives market where as you can't afford to have uh, no stop loss, you got to have a stop loss, so you can't afford to average. Please don't average, have stop losses. If the market is going against you, take your stop loss and then wait for the next opportunity to trade. And the fourth most important, it links with the first point I made about money management, that is taking too large a position. So if 2% is the max you can risk in one trade, you know how much of position you can take. So taking too large a position, a lot of people become bust. So please don't do this. So if you can keep this 4 points in mind, I think you are safe and sound in any derivatives market, and obviously in the currency derivatives market. Now, with this, we move to the questions. So give us 2 minutes. We have received a number of questions and we'll be taking up a few. So the first question comes from Mr. Jay Ganesh, and his question is, I want to activate currency derivatives. Now, sir, in order to activate currency derivatives, you have two options. Either if you're an online client, you can contact the customer care, and if you are an offline client, you can contact your dealer or RM. The next question is from Priyank, who asks that he actually wants to do a carry trade, which I explained to you. Is it advisable in the current environment? No, because as I outlined, there is too much of risk in the global markets and too much of risk by way of national elections. So carry trade should only be undertaken after the national elections are over, that is next year, and we are clear on the formation of the new government. So that's the reason why since February of this year we have stopped doing carry trades and we have become long on the dollar. That's an important point. The next question is from Nitin, who asks how currency value is decided and what factors drive the currency rate. Now, this is something which we have covered in the presentation, so I think we can skip to the next. From The next question is from Jay Raman. He asked, "Is currency derivative similar to stock derivatives?" No, because the underlying is different. Though in the derivatives part, that is futures and options, it is same. But the contract size is different. The market hours are different, and the individual underlying is different. But the principles of trading are same, which I outlined in the on the slide on mistakes. That you have to be disciplined, and you got to have a strong money management. Otherwise, you are asking for trouble under any derivatives market. Uh, then there is a question from Mr. Rao on the cost of trading currency derivatives, on the commission and the charges. It's around 0.02%, which is there on currency derivatives, apart from the statutory cost, which are there. And the final question comes from Anushri. It's a very interesting question. Actually, it relates to maybe she is following my Twitter posts. It says that in various Twitter posts of yours, you have repeatedly talked about ignoring the current account when analyzing the rupee. Kindly throw some light, as this goes against the way most economists and commentators analyze the currency. This is interesting because I talked about this part in while presenting on the factors that in fact on the myths that you can ignore the trade completely when analyzing the currency trend. Uh, in brief, what matters for the currency market is flows. So that is the cause. So the life becomes relatively easier if one focuses on the cause, that is the flows. And the flows can come in various shapes and sizes. For example, it can be a FDI flow. It can also be a FPI flow, that is foreign institutional investor flow. It can be flows from NRIs who wants to invest in FCNR B account in India. It can be banks going out into international uh, financial markets and raising dollars or euros. So it can be flows like that. Or it can also be, this is very important, RBI. RBI intervening. So when RBI buys dollars, it is an outflow. When RBI sells dollars, it's an inflow. So that's why when RBI buys dollars, the rupee depreciates. Now when RBI is selling dollars, it is trying to appreciate the rupee. So always follow the flows. Uh, it will help you to understand the currency much better than trade. So in a nutshell, you can ignore the current account completely and just focus on the capital flows to understand the rupee. I hope that answers your question, Anushu. It's a very interesting question. With this, uh, we are going to conclude this talk, and thank you once again for being here today. And before I end, I would like to say that we'll be sharing the PPT with the viewers in some time. Thank you.